Welcome to the Trading Bell. Kihara Maina, the Regional CEO I&M Group, is here to help us break down H1 results that have done quite well. We're talking about a 36% profit after tax and, of course, going all the way to 11.7 billion. What have they done? What's different? Welcome to the Trading Bell. Karen, it's good to see you, sir.
Good to see you, Maina.
Yes. Well done on the numbers. And I would like to start with a quick question. If you had to explain H1 in one sentence to a shareholder, what changed most in the business compared to last year?
Thank you, Maina. I think if I was to pick one standout number, it would have to be on the growth in the customer base, right?
Yeah.
We are talking about over 33% growth in customer numbers.
Yeah.
And in the most relevant sectors now for our economy, where we really want to see impact happening in the MSME space. So at 110,000 growth in actually over 250,000 growth in numbers across the group.
Yeah.
That has been really, really strong. That, however, of course, translates into the numbers, the bottom line numbers.
Yeah.
34% growth in PBT, and we're really happy about that.
Okay. I mean, I'm surprised and as well really appreciating the numbers, and kudos to you and your team exactly for this. And I wanted to ask you, what really changed? What did you do differently to produce such a double-digit figure?
I think what you're seeing really is the culmination of several years of really concerted effort in our strategy. Mm-hmm. We have been clear that we want to be relevant in emerging segments, so retail and SME. And you've had the clarion call and you'll hear this in all of our different markets. Mm-hmm. Can banks participate more in lending to the MSME space? Can we provide financial solutions in that space?
Yeah.
When you look at the participation numbers, banking is somewhere in the region of about 22-24% in terms of financial inclusion.
Yeah.
If you include mobile money, that then rises into the 80s and 90s, right?
Yeah.
So there's a lot of work that banks have to do.
Okay.
However, what we have been working on, and this started way back in 2016 when we started on our strategic journey, which we call Imara, and we're now in phase 3, which is the 2024 to 2026 period.
Yeah.
We have been investing heavily in people, in digital. We've been investing heavily in resilience, right?
Yeah.
And across those different areas, we are talking about making sure we equip our people with the skills that they need to be able to thrive and serve our customers in this emerging space, particularly as the world becomes more digital. We've been investing heavily in technology, right? Currently, we have committed about 10% of our total operating expenses in this year to investments in technology. That means we're investing in digital platforms. We have just finished rolling out in Rwanda, which was the last in the cycle in terms of a new digital platform we call DEH. We had done so previously with Tanzania and with Uganda. And in Kenya, which has been leading in that space, we have been one of the leaders in terms of digital in the banking space. We put in a digital factory in about 2017. And these are the teams that have then developed the platforms that we are now using. Okay. Here in Kenya, we call it OTG, or On the Go, I&M On the Go. And the team has been very, very innovative. And we are seeing the responsiveness in our customers. Yeah. And they are also happy, of course, with the resilience of the systems. Okay. We know that there are challenges. Cybersecurity is a big challenge in our markets. So investing in resilience is really important. All right. So this is really the culmination of that. And as we expand into the retail space, we're digital-led and making sure that we are designing solutions that are relevant for our customers and servicing them on those platforms.
And we shall get into the context, especially on the retail stage, which has done quite well. And just for the sake of context for our viewers, we're talking profit before tax surged 34% to 11.7 billion, profit after tax 36%. Now, let's move on a bit to some of the subsidiaries, and you've spoken a little bit about that. But Kenya seems to have totally outpaced its peers, if I may use that, when I look around the color of the subsidiaries. Give us some context. What are you seeing?
So it's across the board.
Yeah.
And I must commend the teams across the board in the corporate space, in the retail teams. They're all very well led. The growth has certainly come from a mix of different business lines, right?
Yeah.
We have a very successful product in the retail space. It's a 30-day loan.
Okay.
Right? It's a digital loan for 30 days. But we find that it's very similar to mobile lending,
Okay.
right? And the churn is perhaps every 8 days or so.
Yeah.
And when we look at all of the lending that we're seeing, it's coming in at almost 600 to 700 million shillings every month, cycling through customers who are repeat borrowers. So that has really helped in generating significant revenues off the retail book.
Okay.
At the same time, yes, the interest rates have been coming down, and I think that's commendable. We've seen the different policymakers pushing that.
Sure.
What we've had to do is also manage the margins on the book, and you will see that we've seen strong net interest income growth as well, despite the interest rates coming down.
Yeah.
And that's really about asset liability management and just making sure that we are really prudent about how we manage those margins. But we have also seen strong growth on the non-funded revenues. So the treasury teams, on the foreign exchange trading as well, significant rise in volumes despite the thinning margins. Of course, the currency has been very stable. So that has also helped. And of course, we continue to be one of the leading banks on the trade finance side. Okay. And the work that we've been doing in support for the G2G oil supplies in the economy continues, and that has also contributed to the non-financial revenues as well. Okay. So across the board, strong growth in revenues, over 21% in that space, and then in terms of cost, also growing prudently, just about 11%. So the pace of revenue growth over the pace of cost growth is solid. Okay. And at the same time, we have also been really managing the non-performing loan side, making sure that provisions are prudently held. And it has perhaps been not as high as other banks have reported. So when you combine all of that, you see much stronger numbers than in terms of percentage growth than some of our peer banks.
Yeah, you have spoken quite a number of areas, and I will be touching a bit on it in a deeper way. But let me point out on the group loans. When I look at the macro environment, and you spoke colorfully about it, how it has been probably one of the stable ones that we have seen over the time, especially speaking about the interest rates, as you've said again, going down. But we're not seeing a quick reference to it, especially to your customers when it comes to loans. You said it is a positive thing. Will this come to fruition over time, or what are you saying?
Yes. So I think, Maina, we have to appreciate that banks also have to manage the pace at which they're changing the rates on their books. This is the asset and liability management that I spoke to. So yes, we have loan books that are priced off the changing benchmarks that we see in the markets. And everybody wants to see adjustments to that, right? However, remember, we as banks lend our depositors money, right? And that means that we have to be cognizant of what deposit rates are at the time. Now, depositors are also prudent investors. So what they look at is what direction are interest rates going. If they're starting to come down, they'll start parking their money in the long end of the curve, right? So they'll be looking for 1 year, 2 year deposits, and some of that will be at some of the higher interest rates that we had that are stickier, right? So the pace at which your average cost of deposits comes down is not as fast as perhaps you're seeing in the other macros.
Yeah.
So that's why banks tend to adjust a bit less quickly than everybody would like. Okay. Eventually it does come down, okay, right? Because nothing makes people panic more than banks that are perhaps not making money.
Absolutely, yeah. We would be surprised on that. Still on the lending and balance sheet. Yeah. In the presentation, I had the Agrilending and SME loans, yes, which you're quite bullish about. But also keen on the Agrilending, which is considered as one of the risky areas to try and tap on. But you seem to be very comfortable in that area. And I wanted you to probably highlight on that. And what exactly are you seeing traction in agribusiness, and how material can this segment become?
So I think this is where, as we talked about in the presentation, banks have to be more relevant to the economies that they serve. And yes, I talked about the participation rates that we see, financial inclusion rates. Mm-hmm. The reason that that is so low for banks at about the 22-24% is that the areas where most of the people in the economy are employed are actually not as well served by banks. So agriculture is a big player. It makes up somewhere in the region of about 25 to 30% of GDP across our different markets. Absolutely. It is the largest employer. It talks about 75 to 80% of the people in the economy are employed by the agricultural sector. However, access to finance in the agri space has been relatively poor. I think for us, it makes up, when we look at the entire value chain, so primary agriculture, agri-processing, it's currently at about the 10 to 11% mark. We would like to, but when we look at it, when we consider where that is located, it's primarily in your corporate space. You're talking your big commercial agricultural players and the big processors. Where we need to be more impactful is your smaller farmers, your aggregated producers, your value chain in the agro-processing, light industry, and so on. Okay. So what we're looking at is how we can commit more resources into that space. And by committing resources, I mean not just balance sheet, but also making sure we have the teams who can better understand what it is that clients are doing in that space. Okay. But also to deal, we won't simply throw the money at the problem. We also have to understand actually what are the challenges that these sectors face, and we work with partners who have been really active in this area to say how do we de-risk some of the challenges that we see. A lot of times it will be about let's do some loss sharing, right? So if you land into this space, if we make any losses, they participate in those losses. What we have seen is that when we partner with partners like those, yes, we get our feet wet, we understand what's going on. The loss experience isn't as bad as we have expected. And actually, we have never called up any of those loss sharing guarantees for all of the interventions that we've done so far. Okay. So what that allows us to do is to start expanding the scale of lending in that space. And what we're looking for are partners, of course, that are organized, right? It's can we look at the entire value chain and say, do we work with anchor corporate clients and the outgrow systems that they have? Do we work with agricultural SACCOs to provide that finance? So that's really where that is going, and I think it can be a significant player. Okay. If we really want it to be relevant and transformational for our economy, we have to participate more in that area as banks. Certainly, we at I&M are looking at that. Now,
you've mentioned about the NPLs. I must admit, I got a bit of a surprise because looking at the industry, the numbers have been going up. Some of your peers as well, the numbers have gone up, but yours have gone down. Yes. And I just wanted to know, what has been the mechanism behind it? Are you repricing? Are you giving provisions? Or what's happened? What's the strategy behind it?
So again, we've been looking at the trends over the last few years, right? Yeah. So this is not just a simple 6-month exercise, right? Yeah. And if you look at where the NPLs come from, broadly across the banking sector, it's from the manufacturing space, retail and trade, and the building and construction, and the real estate space. So these trends were we could spot them because these are the principal areas in our book that we have been surveying.
Yeah.
So from a credit policy perspective, we started tightening on that perhaps 2+ years ago.
Yeah.
And as a result, we have been very particular about what kind of assets we've been writing on the book. So as they start turning, we haven't been as heavily impacted.
Yeah.
That doesn't mean that we haven't been working out a lot of these challenges with our customers.
Yeah.
We've gone through workouts together with our customers. You always want to see whether you can deal with a problem before it becomes too toxic. But when it does become a reality and you get your NPLs, you then also want to walk through the paces, right?
Yeah.
See what it is that you can do to use secondary repayment sources, right? But at the same time, that has been complemented by your regulatory-driven, write-downs on the balance sheet, right? So if you've been nursing an NPL for very long and it's not getting you anywhere, it's time to take it off the books, right? It doesn't mean that you don't continue collecting. It's just not sitting on the balance sheet and dragging down the efficiency of the balance sheet. But we've had some really good work done by our recoveries and collections teams, and that has helped tremendously.
All right. Let's move to the corporate and investment bank, institutional banking.
Yeah.
One of the things I've noted is that there's a significant jump as well in that sector. And I wanted to ask you, is this mainly from FX trading? And even as you speak about that, I have noticed as well, from other peers as well, that FX trading really didn't see much of a significant improvement, especially with credit to the stability of the currency. But it's not the case on your end. I don't know whether it's volumes or what are you observing?
So yes, again, the revenues in the corporate and institutional banking space have also been very broad-based in terms of growth, right? So the asset and liability management space, managing the margins so that we can get a strong net interest income growth has also been strong, right? And that you will see has led to a 12% growth in the deposit book, even though the loan book is just grown by about 2%. What that has meant is that you have more funds to deploy, so you're getting net interest income. Even as interest rates are coming down, you're still managing that increment to income. However, on the non-funded income side, the FX numbers are really a tale of expanded volumes, right? Now, the reality is that when you have stable currency, you tend to see margins thin very, very much.
Absolutely.
So the way to deal with growth is really to work on volumes, right? And that is going to come through in two broad ways. One is to increase the customer base that you're dealing with, right? And that comes through the service quality, better relationship management. The other one is to increase the number of partners you're working with, right? We have seen significant inflows coming in from the diaspora, right? That comes in through channel partners. And we've been tying up with more channel partners to just make sure that we are assisting them with their FX needs because they're sending in foreign currency. They want shillings to get to our customers, and we facilitate that process. So that's where we have seen that growth coming from.
I was keen to know whether your regional stretch, because Mauritius all the way, whether it's one of the things that have contributed to your great effects.
So it hasn't been that really. Yes, we do see flows going into the Mauritius space. It's an offshore banking market, and we facilitate that corridor. But it's not really the driver of FX in that regard.
Just checking on that. As we near the close of the conversation, I heard you speak about the new focus areas that you decided to, diversify as much. And you talked about oil and gas, which you've mentioned here, public sector, which a lot of people fear getting into. Then you also talked about China desk and leasing. Just very quickly, can you paint some color to this?
So we were I talked earlier about the focus areas that we had in corporate, right?
Yeah.
And that were driving NPLs, right?
Yeah.
So we're very big in manufacturing. We've grown with a lot of the companies that are in industrial Kenya, right?
Yeah.
So manufacturing, retail, and trade, and building and construction, and real estate.
Yeah.
What we saw was that we needed to diversify the sectors in which we were operating. So we started building out our capability in the oil and gas space, right? So we were one of the first banks to get into the G2G partnership. And that took it was a big step really for us to take, because at the time there was so much currency volatility. Everybody's worrying, are you going to be able to meet your obligations and so on? But the structure that was put in place eventually, I think, bore fruit, and it helped us to really get ourselves into that space, and not just the direct oil marketers, but also the rest of the value chain. So we've been really working on that and expanding it regionally. We have the same kind of focus within the rest of the markets, because oil is a big import, import in each economy, right? Absolutely. You're talking about 25 to 30% of imports coming into the oil space. So we've been expanding that team. The leasing space, we need to make this transition, I think, in Kenya and in all our markets, right? Ideally, it helps to free up balance sheets for customers if they can focus on leasing. It has been there for a while. We have been looking to get into it a lot more strongly, so we've been building our muscles in that space as well. And then the other sectors are really just about how do we make sure that we diversify away from just the core sectors that we had, and balance out this growth, because this is where we are seeing it across the economy. Can we support our customers as they build out in that area? So this diversification is important. You really don't want to put your eggs in one basket.
Is the China desk more on trade? So
China desk is really something that we appreciated was about the trade corridor, right? We are seeing China's dominance in the imports that we have into the country. So we realized that a lot of the, and there are a lot of Chinese businessmen in Kenya, in East Africa, right? Enough that they even have their own chamber of commerce. They're looking at how they can more effectively promote business within the markets that they're operating in. So we set up a desk. It's manned by people who can speak Chinese, and we are looking at how we can engage with our customers to understand their needs better and facilitate trade along that corridor.
Looking at the last 2 years, wealth management, super done well. Rocketed from 13 billion to 70 billion, looking at the last 2 years. I wanted to ask you, what's really this growth? What are you doing differently?
So it's early maturity now, let me say, because I think we are in our fourth year since we started.
To launch it,
And this has been really driven by growth in customer numbers as well. We've actually just done about 2.5 times the number of customers in just the last 1 year. And that is also going to really be a reflection of the trend in interest rates that we've been seeing, right? So if interest rates are coming down on your treasury bills, deposits are coming down, what customers are looking for is, where can I continue to see some of the higher returns that I was seeing? And these money market funds have seen a bit of a lag in terms of how quickly the effective yields have been dropping. So customers have obviously been very attracted to that. We are the leading fund in the dollar space, right? The money market fund in the US dollar space. We are the largest in the market. And couple that with easy access. We are digitizing the access for customers. It helps with growing. And that's why you've seen the growth from about 20 billion shillings to 70 billion shillings in assets under management. So we're happy with how it has grown. We're looking at seeing more of this mutualization of funds happen. It helps with efficiencies coming into the banking sector.
Okay. Finally, to the shareholders, this conversation a lot is watched by your shareholders and prospective ones as well. We talk about your share price, which has steadily grown. We have seen that from the graph itself. Maybe you could just touch on the confidence in fundamentals that you see in it. And finally, dividends, whatever you will say about that.
Right. So yes, we are, obviously, we watch the share price closely to see whether it is telling the story of what we feel is the intrinsic value of the business.
Yeah.
In recent years and months, it has caught up, and we are now seeing our share price at about the 35 shilling mark.
Yeah.
However, when we look at the price to book ratio, that's still not moved as much as we'd expect. And we appreciate that across the industry, it's probably at about 0.8, 0.9% price to book ratio. We are currently at about the 0.65%, 0.65 mark when it comes to price to book, right? So we expect to see that rise.
Okay.
But that is really a function of the markets. When we juxtapose that with the net asset value per share, it isn't the same story.
Okay.
We expect to see that gap closing.
Okay.
But all we can do really is continue to tell our story, make sure that investors understand the proposition of I&M, and eventually the market will translate that into value. Now, of course, that comes with a dividend story.
Yeah.
And yes, last year, for the first time in our history, we gave an interim dividend. And I know there'll be lots of questions about whether that is going to happen. This time, we've already announced that it's at the half-year mark. We haven't made any decision on that.
Okay.
But the sentiments have been received from the investor community. They will be seriously considered. What, however, we always also juxtapose that with is the capital needs that we have within the business. And we are still seeing, growth within the year, and we will be able to get back to the markets on whether that will happen or not. Most important is that shareholders then understand that we are preserving value for them.
Okay.
Yeah.
Full year is coming. When we sit here, Kihara, what is that one headline you'd want to see at the end of it all?
So we sustain the performance that we had seen at the half-year mark, and we see it through to the full year.
Yeah.
More importantly, we get to impact the lives that we have been targeting. We have talked about impacting 10 million lives. We've been doing that principally through our I&M Foundation and our ecosystem partnerships.
Yeah.
So we want to be able to tell us a story of impact.
Okay.
And hopefully that's where we will be.
Thank you so much for your time.
Thank you very much, Maina.
Absolutely. There you have it. That's Kihara Maina, Regional CEO I&M Group, breaking down the H1 results and very optimistic about the full year as well and looking forward. We will wait to hear that story of impact. Thank you so much for your time. I'll leave you now with the markets.